This video is brought to you by Axo Copper.
Hello, welcome back to Mining Network. It is Thursday, the 12th of June, and I'm with Michael Oliver, the founder and chief analyst at MSA. Michael, good to be with you.
Good to be here, Peter.
I saw on another interview that you were talking about we're potentially at a crisis point in terms of debt. And I do wonder, obviously, I think the debt to GDP ratio is about 124% now. I think the debt on interest alone that the US is looking to pay in 2025 is just short of $1 trillion. Obviously, tax revenue is only around 5 trillion. The 20% of tax revenue now being spent on repaying debt, it's not looking great. I guess the main question is how much of this are you looking at potentially a crisis for the bonds and also the stock market, and also how much do you believe that the US can sort of weather this? Obviously, Japan has a GDP debt ratio around 200%, and they're still here.
Yeah, flying high. Okay, we analyze T-bonds technically. T-bond futures, 30-year maturity, and gee, that market's been around 50 years now. The futures market. In October of 2020, T-bond futures were trading between 170 and 180. Yields were very low. And at that point, we turned long-term bearish. And it started down, and in late 2022, they finally really started to come apart on the downside, meaning yields rise. They almost what you would call a crash event between late 2020 and that I think it was September 2022 low. Huge collapse in price, rise in yields. If you get a chart of yields or the T-bond futures and go back to July of 2020, or was it September, somewhere in there anyway, and just draw a line horizontally, you'll see that yields and price have basically just been doing this. But what that means is they've been doing it going sideways at choking levels for debt-related companies and governments and so forth. So it's a problem, and it hasn't gotten better. Despite the Fed cutting rates at one point didn't help the bonds, et cetera, et cetera. It didn't impact. They don't impact that into the market very much. We all know, Jamie Dimon of J.P. Morgan and a lot of others have said, this is it. We're going to come to the resolution of this crisis. It's been going on for decades. It just gets worse and worse every 4 to 8 years. It doesn't matter who's president. The debt gets worse. And Trump has proven that as well. So can you keep doing that forever? Can reality be denied forever? Or does suddenly reality snap at you and clear the deck? You throw it up. Okay. I suspect that's where we are now, technically. But there has been an obvious, especially over the last month or so, an obvious tone in the T-bond market that is unusual. First off, we, MSA, actually got positive on T-bonds for a trading move, trading meaning several months surge, drop in yields, late last year. And sure enough, they started the rally nicely. They went from like 114 on the T-bonds up to 122 early in April. And they crashed within 2.5 days. It went from 122 in price to 111 in change. 11 full points in 2.5 trading days is massive for T-bonds. Something happened. Okay. At that point, I have no doubt that the Federal Reserve panicked. They have to. They talk about all the data points they want to. Economy's doing this, job market's doing that. But the real issue is their own debt, the government's debt. How do they control and handle it? Well, as Powell smugly and smilingly deals with each press conference like, oh, everything's looking good, we don't need to do anything. The head of the Boston Fed, I forget her name, but she spoke like about 2 months ago, and it was like a week after Powell had a very calm press conference. She came out and said the Fed has, quote, multiple tools to deal with any financial crisis. Now, why would she come out and make a statement like that? In other words, they don't just have interest rates they can play with, but they've got QEs they can pull out of their pocket. They did that before. It didn't do a lot of good. But why would she make a statement like that? You know, it had to be approved from higher up to make a statement like that. She's admitting something's wrong out there, a financial, quote, crisis. We can deal with it if it happens, she said. She didn't claim it was happening, but why would she make the statement? Well, the tone in the bond market over the last month is every time it tries to get down to certain levels that we regard, MSA, regards as technically Bombay door opening. Specifically, it's around 110 on T-bonds. They keep coming down into the 111s and into the 110s even, but they don't get to the 110 level. And the tone of the market, it's like there's some kind of glove under it. It's not normal trading swings back up. It's like somebody's just saying, no, you're not going any lower. Now, I don't know if the Fed's doing something. We don't know that, of course. But it wouldn't surprise me that the government is in there manipulating, trying to hold that market steady. Because if that market ever slips another big notch, there's a lot of companies out there and a lot of borrowers who are in trouble. Now, I understand, and I don't pay attention to fundamentals that much. We're technical and we use momentum of price primarily. But the commercial real estate market is heavily in debt. Everybody knows that I read about. So they're heavily in debt. And a lot of that debt is apparently coming due this year and next. It's long-dated debt, not dependent on what the Fed rates are. And we just had about 2 months ago, the largest shopping center in the U.S. defaulted on $300 million in debt. Boom. Now, so far, this is not a headline, but I suspect this is going to impact the stock market if things don't get better, and I don't think they're going to. I think all the central bank is doing is delaying. Anyway, that's my assessment of T-bonds.
How much of an influence do external forces? It was long rumored that, for example, when the trade negotiate or the tariff negotiations were happening, and we saw that tit for tat with China, it was rumored that China was the one who was sort of battering down the bond market overnight, which led to Trump sort of removing tariffs from all other nations. Do you think there's interference there? Not maybe you were hinting there that it could be the Fed.
Well, I don't pay attention to who's buying and selling. I look at the charts, and it's obvious there's a heavy hand on this market and has been for 3 years now, where it just can't get a rally going. Yields can't drop. And I understand that some major foreign governments are divesting themselves of large portfolios in T-bonds that they've held for years. They're shrinking those down. And that no doubt includes the Chinese. So that's all I can say to that. It's just that the technicals right now, the long-term bond market technicals, we're using things like quarterly momentum and annual momentum. This is when you measure something not versus a 3-week average or even a 200-day. You're examining its trend in relation to the momentum situation is very heavy looking. The question is, will it punch through and generate what we would call a panic, something that looks out of control? And all I can say right now is it looks like they're trying to keep it from doing that, but I don't know whether they can do that. This is a big, big market, bigger than the U.S. stock market. So it's a crisis pending, and it's going to have wave effects in all kinds of markets. And there's another factor we can talk about, too, at some point, dollar.
Hi, I'm Jonathan Aguilo. My colleagues and I have been behind 7 mining success stories over the past 20 years in Mexico, most recently being Go Gold and Silver Tiger with a combined value of more than $1 billion. 3 years ago, we formed Anarcho-Capitalism. On June 4th, we IPO'd on the TSXV under the trading symbol AXO. Our La Huerta project is a recently producing high-grade copper mine in Jalisco, Mexico. When we picked up the project, previous operators had only mined to 50 meters depth and about 150 meters along strike. For us, the opportunity came to test the scale of the project, which we've already begun. The drilling has already achieved intercepts including 13.7 meters at 5% copper and 7.6 meters at over 7% copper, testing mineralization to a depth of 200 meters. We've tracked the system to 5 kilometers along strike from surface sampling. We believe there are all the signs for there to be multiple high-grade copper systems within our 11,000 hectare license. We've just raised $11.5 million Canadian and have started a 15,000 meter drill program, with about 70% of that focused on the existing mine area and 30% to test regional targets. Over the next 12 months, we plan to test the scale of the project, giving us the information required to assess at what rate the mine should be restarted. As a new company, we would be honored to have you follow our journey as we test this new emerging high-grade copper district.
Well, one of my questions was actually going to be about the dollar. Maybe we can just talk about that now, because I did want to talk to you about gold and silver, but we can put that off until a bit later. Obviously, the dollar's weakening a bit at the moment. I'm reading that as potentially a bit of an influence on the higher silver price, for example, as you do usually see assets increase in value as the dollar weakens. But yeah, what are you reading from this, especially in relation to bonds, like you're alluding to?
Well, we assess the dollar index more or less constantly. At least once a month we update it. And, we've been major bullish, we've been bearish and so forth. But what happened in 2022 is bonds went up in price now to about 115. No, excuse me, 120 or higher. They collapsed in late 2022, and then they went dead. If you look at a T-bond chart, no, it should be a dollar index chart. It went sideways at and above 100 on the dollar index. That was the floor for 2 years, 2023, 2024. And the rally highs would generally get up to 107, 108. So it was stuck in an 8% trading range for 2 years, meaning the dollar index, which is the inverse of primarily the euro and the yen, by the way, was a non-event. It wasn't a wave creator, neither positive nor negative. It was what we call the quiet one. Okay. And there was a rally effort in late 2024 that punched up out of that range. It got up to 110 and then immediately fell back into the range in that 100 to about 107 range. And in April, we turned major bearish. Price of the dollar index then was 104.21. Excuse me, the March close, 104.21. Because we'd broken an annual momentum trend structure. You couldn't see it on a price chart. In fact, if you look at price, 104 was just in the middle of the prior 2-year range, so who cares? But momentum said, no, you're gone. What happened after that is we dropped down to 98, rebounded back to 101, and now we're trading back under 98 today as we speak. There is a secondary trigger level on the dollar index that if you close any month at 98.34 or lower, precise number, that closes below the 10-year moving average of the dollar index. Now, so what? It's an average. Sometimes you can cross averages above or below. It doesn't mean anything. In this case, it actually means something because it's structurally important on the bond chart. You're blowing a floor and an uptrend line that goes back decades. In other words, if we're now at a level, you can't close the month here. If you do, you're going to begin to implode in a way that makes headlines, meaning has wave effects for a change. So suddenly Forex is going to become a dynamic. It hasn't been for 23 and 24. And I look at what does that mean? Well, I mean, if you own UST bonds and you're a foreign government, you buy them in dollars, and you own, or you're a foreign investor and you're heavily invested in the U.S. stock market, which has been the case for the last couple of years, more so than ever. You're getting hurt not just by any drop in those assets, but in the dollar drop. And the dollar is about to become a wave creator, and it will further exacerbate the bond situation. So watch the dollar index.
Does it also not create an opportunity, though, because as the dollar drops, other people with cash, countries, obviously they'll then might be incentivized to buy more at the same time as other people might be panicking?
Yeah. But the dollar is, we comfortably buy the stock market or any asset in the U.S. and investors think, oh, it went up, therefore it's good. Well, what if the dollar's real value went down? Not versus other currencies, but its real buying power. It doubles in quantity, M2, for example. It almost doubles every decade. You go back to the 1950s, and you get the M2 chart from the Federal Reserve of St. Louis, and just click on like January 1970, January 1980, and do the math. And you will see that every decade, it basically gets cut in half in terms of real buying power. So when I was a little kid, a loaf of bread was 20 cents. Okay, well, it isn't anymore. And that's not because we have a wheat drought, okay? It's because of the degradation in the money unit. Well, investors here don't tend to pay attention because they think in terms of dollars, But a foreign investor, he factors that in because he's got to convert it back to euros or yen. And lo and behold, he didn't make as much money because the dollar decayed. So it is a wave factor. It will also help gold and the monetary metals. It's not one of those factors that is direct push-pull on gold. Because if you go back a decade, right now, for example, dollar index is trading in the 97s. Do you know where it was in December of 2015 when gold made its low at 1,050? The dollar index is right where it is right now. So if you could draw a sideways line for 10 years, dollar really hasn't gone anywhere, and yet gold is doubled in a half. So it doesn't always have a direct impact, but it will, in this case, I think, be a further goose for the monetary metals.
Interesting. Well, why don't we talk about monetary metals? Obviously, silver's going on somewhat of another rally over the last couple of weeks. Gold is holding quite strong above the 3,300 mark. Even just moving away from monetary metals, you look at things like copper up to about 450 a pound is looking quite healthy. What's happening?
Well, it's an ongoing trend. And first, in other words, MSA, based on annual momentum of gold, went bearish in 2012 and then went bullish in February of 2016. Nothing since February of 2016, that was like 3 months off the low. Gold then was like $1,140. Nothing on annual momentum since then has changed. It's had ups and downs, but the trend has remained positive. And therefore, long-term basis, we just simply remain bullish. We ignore the sell-offs. They don't last. And I think we've now entered, especially in silver, an acceleration phase where what we've seen, for example, last March of 2024, we put out another signal on gold and silver and the miners that said, okay, the sleepy period we've just gone through, 2020 to 2023, is over. We're going back up. We're going to accelerate. Not full acceleration, but we're going to come up out of the hole. And they did. They surged big. Gold was 2,000, it's now 3,400. Silver was 25, 26, it's now 37. Okay. There was a pause, though, for example, in the silver market. If you go back to last May, silver got up to $32.70 in a surge. And then it went more or less sideways, but in a widening type pattern of up, down, up, down. But you could draw a line from May of last year across the next year of action, and it simply cut right through it. Silver went above it, went below it, but basically it was nothing. Silver held its own. And during that time, our long-term momentum studies showed that it was in a corrective phase, meaning momentum, which got sort of overheated last May, started to correct. And when you look at a momentum chart, there's this perfect, beautiful channel that we were in since May of last year through 2 weeks ago. And when silver came back up recently to 34.90, near its prior two highs at 35, that structure broke out. And boy, within a week or so, we're $37. I think that's the beginning of an acceleration move in silver that will do two things. Put silver well beyond the old 50 highs, and probably within the next 3 to 5 months that will occur. Meaning something like $60 to $70 would not surprise at all. Not that that's the end of the move. That's just what's likely to unfold in the next 3 to 5 months. I think also during that time, you'll see silver start to outperform gold in a fairly dramatic way. Where silver now, as we know, is very undervalued to gold. And when we technically analyze that spread relationship between silver and its mama market gold, we see the upturn occurring, where silver's starting to break out versus gold. And I think that, plus the acceleration of the price of silver, those combined will create a situation in silver that will be stunning for most people, and will also surprise those who thought gold was going to lead, because I think it's going to be the other way around, though. Same is true with the miners, by the way.
Yeah. Just remind me, in the past when we have seen gold break out, does silver usually track with it, or is it
yes.
usually lag behind?
There was a mistake by many investors back in early April when the stock market in the U.S. had that puke. We had the little mini crash drop. Well, actually, it was only 20% from the high, but still a sharp drop. They dumped into the commodity complex then too, thinking, well, if the economy is going to be bad, so are commodities. And they treated silver not like it's part of the gold market, but it's part of the commodity sector. So gold pulled back like 3 or 4 or 5%, nothing hardly. And silver dropped from $35 to $27.50 in a matter of like a week or so, most of that occurring in 2.5 days in the end of the first week of April. 27.50, and I no doubt everybody in silver pulled their hair out. Well, all of a sudden now we got to 37, and it's only been what 2 months, basically 2 months. So that was a falsehood. So your question was move with gold. Silver, I think, suddenly realized, oops, I don't belong down here. I'm not a base commodity. I'm coming out of here, and it came out in a vortex manner. And by the way, so did commodities. They came up out of the hole as well. And I think that was a statement that anybody paying attention should realize. Silver is part of the monetary complex. It is a money. And don't be trapped by those occasional times when it seems to say, no, I'm not, because it ultimately will track with gold.
Yeah. How are we seeing this translate in the equity market?
Yeah, I sent you a couple charts. First one was the GDX spread versus gold. And what we did is we went back to 2015 on that chart, which is what? That's when both of those markets made their net price bare lows in December of 2015. And we plot month to month, where did GDX close in its relationship to gold? Meaning we divide GDX price into the price of gold, express it as a percent. And therefore that's the chart. In fact, there's 2 charts there. One's a momentum chart below the top chart, which is the spread chart. But you'll see that since 2020, over the last 10 years at least, there's been a couple times when GDX got up to the upper range of that spread chart. But in 2020, it got up there again. And then since 2020 through just recently, the miners have, while they've risen in price, they've underperformed gold. They've not matched its gains on a percent basis. But that spread is breaking out now. And it's a pretty good, clear trend line you can see on that spread chart, where since 2000, so 4 full years of pulling back on the spread. If that were a price chart, the top chart, you'd say, I won't buy that. It's breaking out. And the momentum chart below is even doing more so. It's even stronger looking. So what we're arguing is now that not only will the metals likely accelerate in their price advance, percent gain month over month, but GDX will beat gold. The miners are coming back. There's another chart I sent you that goes back to the 1980s. And that chart shows the monthly closes of the XAU index, which has been around since then, which is the Philadelphia Gold and Silver Miners Index. And what we've plotted there is each month's close of XAU in relation to an ounce of gold. Okay. And you can see that from the 1980s through about 2007 or so, that spread remained in a range with lows at around 17.5%, again, dividing XAU into gold, and highs up around 30-something% over. So that was its ground then. That's where it lived, in that range, up and down, up and down. But then when the bear market started, actually before that, the spread started to break down through the bottom of that range that you can see, again, around 17.5%. And sure enough, the bear market in both miners and gold followed in the couple years that followed. That spread collapsed into 2015 down to like 4-something%. Okay, this is something that had existed in a range from 17.5 to 35, and it dropped. Now, if this were a price chart, and you knew it's not going to zero, I mean, the gold miners aren't going to zero, okay? That spread chart effectively got to zero, and since then, actually the spread is up We're right now at about 6+% XAU index divided into the price of gold. So it's a couple percent off of its low that occurred 10 years ago, the spread low, which actually means, if you do the math, it's done better over the last 10 years than has gold, even though that spread chart is still laying in that basing action. We think that spread's about to move up out of that base. Okay, let's assume that's true. Like the evidence I showed with GDX versus gold. Okay, XAU, same story. You come up out of that base and you look at that chart of XAU versus gold and treat it as a price chart, and you draw that line at the lows of 1980s, 1990s into 2000. It says, oh, where's resistance? Well, about 17.5%. You come up out of this base on XAU versus gold, and you could triple its relative value to gold. And in other words, if what we've been seeing for 10 years is basing action of the miners versus gold, and they're coming up out of here now, which we assess that they are, the next resistance is effectively a triple from current levels. Meaning, whatever we see over the next year or two in gold, you're likely to see the gold miners double and triple what gold is doing, just to get back to the bottom end of its old reality. Now, what does that mean? It says, well, watch gold, but you want to be in the miners. Similar with silver.
So long as you have a good outlook view on gold, you should have an even better one for the miners in your...
Yeah, gold has done really nothing so far, but it says, my, what a move. Really, the 1980 peak, when we got to 850 gold, was an 8-fold move. Okay, the 2000 to 2011 move was an 8-fold move. Okay, gold is coming from a bare low at 1,050. 8-fold is like $9,000. Okay, that would only be matching the logarithmic scale move that we've already seen twice in the past 50 years. And those times were far less dynamic, both fundamentally and technically, than now. We have more dynamite in the box right now than ever, in terms of these other, we were talking about these other markets, which will help drive central banks into craziness.
What about the silver miners? Sometimes they're really out of favor. At the moment, they seem a bit more.
Yeah, same story. Same story. They have, we don't show the chart here, but there's if you run a spread of SIL, the silver miner ETF, versus GDX, for example. And by the way, GDX does hold some silver miners, so it's got about 6 big miners in it, silver miners, but it's primarily gold miners. If you measure that spread, silver miners are starting to assert themselves, and they're not quite at a breakout level, but there is a level that we update usually about weekly, where the SIL versus GDX breaks out of a pretty good-looking base, such that at that point in time, when that occurs, that will be further fuel in the tank, indicating something's going on here. Money is moving from the gold miners into the silver miners, just as the money will move into silver, vastly undervalued relative to gold. And I think the silver miners, in fact, personally, that's where I primarily am invested. I do have some GDX exposure, but I am primarily emphasis on silver miners.
When you say miners, you're talking about producing silver companies, not the junior side of the market so much.
Yeah, not so much the juniors at this point. No, Core, for example, Pan Am, a couple others that I own. And there'll be a point where the juniors will likely suddenly become firecrackers. And usually that will occur when the average Joe investor who's missed this entire move in the miners, been told there's nothing going on there. And in fact, if you measure GDX versus the S&P, it's matched the S&P since 2015. Hard to believe. It's both underperformed and outperformed. But if you take the current measurement, GDX versus S&P, and draw a line sideways and go back 10 years, we're actually slightly higher than we were in 2015 when miners made a low. But it's when money flows out of the stock market seeking a better place to be. And right now we're starting to hear some analysts saying, hey, this gold's working out, and so are the miners, because suddenly you notice the miners have gotten strong. And that attracts late money. And I think you're going to see when that late money comes in, we've got a tiny little market there. Doesn't take much money movement to goose it, a lot.
Oh no, the junior side. I mean, I mean, a fraction of what goes into the majors goes into the junior market. It's a pretty good time for them. So what are we waiting on to see a move in the junior market? What do we need to see a bit more momentum with the majors before we start seeing that money flow in?
Yeah, we'll see it on the spread, and I'm not going to try to explain why it's occurring. And, the whys would be what I just said: money moving into the gold and silver miners, and a lot of that money seeking the lower priced ones, so they can buy more of them. Get the psychological idea there. But the other factor is the silver relationship to gold. If silver's going to suddenly outperform gold, why are the silver miners going to stay below the gold miners? They should do effectively the same thing. And technically, they look poised to do just that. And by the way, on a net price basis, the current surge that we're in the miners in general, like GDX, GDXJ, or SIL, I think it's easy in the next 3 to 5 months that we will exceed the 2011 price peaks. I think that's no issue. And of course, if gold ever does its normal, which is to say an 8-fold move, and XAU goes up to 17.5% or triples its current relative value, wow. I mean, it will be the hottest place in the market. And the issue is you should have gotten in already. And if you're going to get in, you better get in now, because in 5 months from now, it's going to be a much higher risk, much more volatility, and you're getting in late.
I guess what do you need to see to over the next couple of weeks or so to indicate that you may be?
Nothing really. We just got it. For silver, we've been watching this, as I described, this pattern, and it was a 40-week average momentum, which is like a 3/4, almost a 200-day. But the oscillator had created a tube. You couldn't see it on price. Price was random almost for a year. But momentum had a very disciplined corrective tube it was in, and it broke out of it, getting up to about 34.90 2 weeks ago. And boom! As far as we're concerned, that was the breakout that says we're now commencing a more accelerated phase. And my measured assumption is, and by measured I mean I've gone back and looked at prior points in past when silver's gone into acceleration phases, especially relative to gold even. What does it do during that period of time? It's no longer 2 steps up, 1 back, or 4 up, 3 back, like we've had for the last year. It's something like 8 or 10 steps up, 1 back. In other words, the market totally changes its nature and tone, and it fools a lot of people, because a lot of people take these everyday measures they've got on their computer for free, RSI, MACD, and they say, oh my God, silver's too high on RSI. Well, it's been measuring silver over the last year or 2 or 3. There's a certain norm has set itself into place. So certain readings get up to certain normal overdone levels. In a dynamic market, you could throw those things out the window. And you might get to overbought levels for 4 or 5 months where you think, oh, it's overbought, and it stays there. And meanwhile, price lifts off. So I suggest to people they don't pay too much attention to the norms of the past. I think we're headed into a headline type phase where no doubt there'll be news stories that come along with it after the fact. Like, oh, silver supply demand balance is imbalanced, et cetera, et cetera. It's been that way for a couple of years, but now suddenly they recognize it. You know how the news stories are. The event happens, then comes the news story. So I think we're at that point right now.
Okay, all right. So essentially, you're not really waiting on any more structural
No,
movement.
I'm not waiting on. I mean, you could wait for gold to touch 3,500 again if you want, but that's technically not important, because frankly, people think, well, gold's topping. Well, get a weekly close-only price chart where you plot the weekly close. Go back a couple years and plot the action in gold since April. It's like boom, 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 boom. It's like dull sideways action. It is not topping action. It's not a spike up that collapses. It's totally asleep. There have been some intra-week spikes, but basically the weekly closes are all like within a 2% cluster for 2 months now, which is not the way gold tops. So it's a launch pad for another move.
Amazing. Okay. All right. Well, look, I hope you're right, because it's going to be a very exciting couple of months in the industry we work. So, Michael, really appreciate your time.
Thank you, Peter.